Good morning, SMF. What we're going to talk about again, like we do every morning, is where is the bear and where is the bull. And by understanding the bear and the bull and the directional movement, now here's the thing, MMTs, the directional movement. For the last several days, every morning in pre-market, we have videotaped these live before the opening bell with the trade management. And if you have a case of amnesia, please go back and look at the videos and it'll come quite clear to you. And here we are again on another day. So basically today's volatility is MMTs. Is that in your platform, you're going to hit the bottom on the bear and you're going to hit the top on the bull in the opening 15-20 minutes. The thing about it is, it's going to tell you clearly when the bull weakens that I go long, meaning that I buy the bear and I short the bull. And throughout the intraday, both will go up and down, and the key Pacific price action elements are as follows. When the bull comes down off of the high, the reversal, is that it's very strong reversal, meaning to support, and then it really bounces. And this number here in the brain would be staying above 65 a lot on the day. Versus yesterday, it was all about this would be below 45 all day and 0 to 25 in your platform, which it was, and this was strong. Every time it pulled back, it bounced hard and went up. It pulled back, it would bounce off support, and it would go up, and this continued to deteriorate, and it's the same one that we were shorting at $114. And there's going to be at every potential market top at resistance, like on the S&P and some of the indexes, you're going to have increased pre-market futures price action. Remember, it's pre-market at 6:15 a.m., 9:15 a.m. Eastern Time, and all of these prices that you see here is basically artificial. Oh, there's only 135,000 shares here, but what do I mean by artificial? That meant that that was the closing price at 64 cents. And it's gapping up above that price. It's not, the market hasn't even opened yet. This is pre-market. And basically, you don't even have to have any buyers to gap the price. That's why on that upside gap, MMTs always, as a market maker, that's where the public wants to come in and buy, and they do. Once they finish their business there, then it's time to sell short against the public up at the highs for the pullback. And same thing on the bottom end today is that we're going to be monitoring that momentum. The opposite, we're looking for just the very opposite of what yesterday was, is a bull would be strong and the bear would be weak all day. If this is the case, that means that when the Netflixes and the Baidus and the Googles and a lot of the leadership trades, and that's related to the NASDAQ and NASDAQ 100 and how they're weighted and what's going to move, is that you want to look at those key price action support levels in our system and that resistance level. What does resistance mean? It means the price doesn't go up any further. It closes below half of the bar, and then that's where that move takes. If we gap up today and we pull back and we're not bouncing and staying up toward the high end of the range, that this is not very, very what it was designed to do, a bull. Meaning that people are going to be buying it and we're going to go up. We're going to see where we slide that intraday reversal so that we know if it's diminishing reversal that the actual bull would be strong off support if it's diminishing in the reversal price action. And basically the same thing over here on the bear is when it hits its support level that it bounces, but when it bounces, that bear price is diminishing upward, meaning that the price action is more of a 2 or 3 teeny move, and it diminishes, and then it rolls over, and this bounces and goes up. So basically, the volatility pre-market futures gap is buy the bear off the bottom when price action is made and shorting the top of that bull. So when the bull falls, you make money, and the bear goes up, you make money, and you make money at the same time. What a wonderful deal. We love this trade. MMTs are taught because that way they're constantly looking at both sides of the market. And they know, and this way they can clearly see where the tech sector will be and other various different things related to the market as far as price action stability.